Start talking.
I don't think, okay, great. So, good morning, everyone. We're going to talk about global markets. Globalization is a fact because of technology, because of integrated global supply chains, because of changes in transportation, and we're not going to be able to build a wall around that. That is what President Obama said before he left office. Today, we're living in a completely new world. I mean, all of this conference, I've been listening to people, and we're talking about massive change. We're talking about a completely different world, a world without borders. I don't know if you're familiar with the fact that today there are close to 300 million people in the world that do not live in the country of their citizenship. So the world is just moving up. By the way, if those 300 million were a country on its own, they would be the sixth biggest country in the world and the wealthiest country in the world. So it's a really interesting concept of what's going on today in the world with, like 10 million Americans living outside of the United States. I have no idea how many people live in the United States that are not Americans, probably close to 100 million people. I'm from the United Kingdom in London. We have over 100 nationalities living in the city of London. 100 nationalities. Now the British government, made forced all the Europeans to register because, we're not part of the European Union anymore because of Brexit. So they had until last week to register in order to stay in the United Kingdom. 5.8 million people registered in 1 week. So this is, when we're looking at how the world is changing today, we understand that really the world is our playground, and we have to start looking at the world in the investment world completely differently to what we did up till today. Let's see how this works. 1 second. No. How do I change slides? Oh, here.
Try the green button.
Okay.
Try the green button there, friend.
Yeah, fine. Okay, so increased globalization and interconnectivity, increased bouts of volatility, lowers bond yields, lowers expected stock returns more in the past. So it's prudent for investors to branch out globally. So this is something that everybody has to consider. Taking the global market, because when you invest globally, you're actually exposing the clients to less risk and not to more risk. Okay? It provides vital tools for all investment managers and to position portfolios for long-term growth. Diversification is really the last free ticket in the investment world, and we can tap new opportunities for growth and harness potential increased importance of emerging markets and alternative investments. Many investors are missing out on these opportunities because we're still living in the old world where professionals are still in just 100% in markets, bonds, and equities, and hardly anything in a wide range of asset classes that can actually create for them better sustainable returns, long-term returns. We have to take into account another thing. We're talking about a new world where people live longer. Living longer means we have to help these families live the life that they want to, of dignity and security. So they need to understand that they can't, when you're an 80-year-old person, to be 100% in a stock market and theoretically with the risk of having 50% of our assets disappear in a day or in a week, that this may not be the right strategies for these kind of people. Now we're going to talk about the latest academic research that indicates that diversification into non-liquid assets, is a global trend. When I'm talking about a global trend, I want you to understand this is much more than a trend. It's even what we would call a global tsunami. We're talking about over $30 trillion. I don't know if everyone is aware here, but the managed assets in the world today is just over 100 trillion US dollars. And by the way, that's up by, I don't know, I think that in 2008 we were talking about 25 trillion. So it's tripled itself. It's just unbelievable the amount of money. It's like a tsunami of money that's moving because of long-term living. People are starting to accumulate money in order to finance their retirement or their long lives. And the governments are not willing anymore to give these defined benefit. So if in the past, we knew we worked for 35 years and then we continue getting our salary from somebody, from the government, from companies, that world is gone. So we have to accumulate the money. And when we accumulate the money, it means that amount of money, the amount of money that there is in the world is just, a major tsunami. And of that 100 trillion, already 30 trillion has moved into non-liquid assets. So I'm going to give a little bit of a background from Professor David Svensson, who unfortunately passed away 2 months ago from cancer. An amazing man. And he built, he's from Yale University, and he built what we call the Yale Model. I think that out of respect to him, they should start calling it the Svensson Model. And I know that he's received a lot of global awards for his academic work on investing, and probably he's the most influential person in the investment world since Harry Markovich, 1952, with the modern portfolio theory. So what is the Yale model? So basically, Svensson embraced a model where he said, listen, liquidity is overrated. It's a great thing, liquidity. Markets are wonderful. They go up, they go down. It's a great tool. We're certainly not saying that it's not something that should exist. But when we're looking for long-term growth, when we're looking to help families achieve their life goals, to live the life that they want to live, we have to explore outside of the box. We have to look at different kinds of assets that are sustainable, that we can trust. And there are a lot of these kind of assets. So this is where he went. He said, listen, how much liquidity do we need? We don't need 100% liquidity. Okay, when we accumulate our assets and we want to live off them, okay, we want to live off the asset, which means if the asset is in a non-liquid platform, like real estate, for instance, that creates returns, rental returns, okay, then we can feel comfortable and we know that we can live the life that we want to live. So basically, he de-emphasized traditional assets. And we're talking about 25 years ago. We're not talking about last month. Last month, unfortunately, was towards the end of his life already, or the end of his life already. But what he did was he de-emphasized the traded assets, the traditional assets of bonds, and he already he saw that the bonds, the government bonds in the future would not be able to deliver the kind of returns that clients need in order to live their lives. And he moved into assets like non-liquid debt, real estate, private equity, etc., 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 infrastructure, all these kind of asset classes he compiled his portfolio of. Basically, he went down to 10%. Take a look at this. 10% of the portfolio is in liquid assets, and 90% of the portfolio was in non-liquid assets. When we're saying non-liquid, just so that we understand, okay, we're not talking about stuff that you can't sell. When you're saying non-liquid, you can't sell it in an hour. When you buy real estate, we all know that we can sell real estate, yeah? And in the States, lately, it's become quite liquid. But so if you want to sell a house, you can actually sell it within a couple of months. But even if you have to wait a year or 2 years in order to get the price that you want, it's still a sellable asset. It's still an asset that accumulates, that has income on a high probability, and also capital growth traditionally, and it seems the last couple of years have been very good for real estate almost everywhere in the world. In the United Kingdom, last year, real estate prices grew by almost 7.5%. That's not including the rental income that you get on the property itself. And in 2021, already I think it's close to 6% in the middle of the year. So that's one of the trends that we have to take into account. Now, also COVID-19 brought us an awareness that we can't continue living the life as we did in the past. We can't continue raping the environment. We have to start becoming socially aware. So socially aware investments are something that is becoming more and more common and in demand in the market. So basically, if when we're making our investments, we want to invest in things that will make the world a better place for us and for the people living with us in this world. So why is there sustainable investing? I just told you. There's also a lot of, it's not only us making sustainable investments, the governments themselves are starting to think completely differently. They're starting to invest in infrastructure for the communities that live within their borders and trying to help people who are unfortunate, like in the United Kingdom, we have our social housing, which provides homes for free. I know that this is something that in the United States, it may be a big surprise. For millions of families, they provide them homes. If the family needs assisted living, for instance, disabled families, or families who have significant social problems and can't afford a house of their own. So we're talking about global diversification, and yeah, global diversification for sure is a trend, but it also comes with challenges. So just to say, let's make our move to become more global in our approach for our clients. And this is a challenge because you have to take into account regulators are not where we are. Okay, you have to remember, we're looking after families. The regulator is looking after the economy of the country and trying to regulate the kind of advice that we're giving people. Okay? But there's a lot of challenges apart from regulation. First of all, quality. When we're talking about alternative investing, it's not the same as in a market. The research, the due diligence behind every single asset is limited, so we don't really know. I said that there was $30 trillion of assets moving into the alternative arena. That's a tsunami of money. When that kind of money starts moving, you don't always have people with wonderful values in that arena. It also attracts people, they say that 50% of lawyers finish 50% of the bottom of the class. So you have to take that into account as well. There are people out there who do not know what they are doing, and that's and there are some people who are doing things that they should never be doing. And we have to be very careful about it. We have to look into the quality of the kind of, who are the people who are making the offerings, what is their experience, et cetera, because we need that margin of safety. So also another thing that, I had one of my mentors who was a very impressive man, and he said to me, listen, Dan, if you don't understand investment in 10 minutes, don't invest. Don't invest. Anything that becomes complicated, anything that, has got so many factors and hedging and all kinds of stuff like that, listen, you can't build your future on it. Maybe, there are some structures out there that are very interesting that can double your money or triple your money. We don't need to be there. Let people do that on their own. We have to look after the families. We have to make sure that these people, can continue living the life that they want, get the returns that they need in high probability, by understanding their needs and understanding where they're going and understanding who they are. And I wrote over here that indexing is a risk. And that's interesting because most people think that indexing actually brings risk down. It does. When you're investing in markets, so if you're investing in an S&P or any of the other massive indexes in the world, so you're getting 1,500, 2,000 companies, of course that's better than investing in one. But you still have the risk of the downside protection, which means that if the market goes down, you're going down. There's nothing to do about it. There's lack of recovery ability because you can't influence an index. You can't say, oh, I don't want to be in the sector of hotels and transportation, okay, because of COVID. I don't want to be there. If they're in those company, in that list of 1,500 companies, you're going to continue getting it because that's the definition of the index. Okay, there's no control over holdings. You don't know what they're going to hold. There's no control over it. Limited exposure to different strategies and no access to alternative strategies. Usually, not usually, always indexes. By the way, it's changing as well. Even indexing is trying to look into alternative investing and trying to create indexes. At the moment, we're not there yet, but this could happen in the future. So, of course, when you're looking at global investing, then there's other things to take into account. One is a currency risk, of course, because if you're investing in the United Kingdom, you're investing in pounds. If you're investing in Europe, that's in euro. And you're investing in Japan, that's in yen. And there are currency fluctuations. So if the dollar continues to be strong, then the dollar loses against, let's say, the pound. So even if even if your investment in pounds went up 10%, and the currency fluctuation means that you lost 10% here on the currency, you've actually made nothing. So that can be hedged, by the way, but you have to take into account that currency is always a risk. There's always political risk. Look at Myanmar, for instance. We thought it had the potential to be the next Thailand, and then it moved forward with great optimism, and suddenly went back to where it was before. And then there's the interest rate risk, which is the interest rate of the countries. So we know that interest rates in the developed world are close to zero and no real promise of any massive change over there. So there's a lot of issues that we have to take into account when we're investing overseas. Also, we have to understand the investment vehicles. So if the question is not only are we investing, is what are we investing in? Okay, so are we investing in a managed account? What's the responsibility? Who's monitoring these investments? Are they regulated? Is there someone who's making sure that we're actually getting what is written in the document, in the prospectus and the offering documents, which defines what kind of investments we're making? Who is responsible if something goes wrong? Are there anyone responsible? Okay, is there a trustee in the fund? Is it a bank with deep pockets? All these kind of things, give us a higher level of confidence. A lot of investors are willing to invest and willing to pay the price of regulation because regulation costs money. So if we're talking about trustees and we're talking about regulators and we're talking about markets, and you all know that to register an investment in a market can cost hundreds of thousands of dollars. In the end, it's paid for by the client. And he has to understand, but these clients are willing to lose that 1% or 2% per annum income for the security that this is actually sustainable, that they won't lose their money because the assets are not written properly, because they never existed, or all these kind of things that we hear are happening in the world all the time. Lack of access to research. Due diligence, a major issue in the world of investing, especially in alternative investing. I'll tell you something, it's very interesting, but 90% of all the problems that alternative investing has had. People have invested in things that have disappeared or, lost all their money and things like that. It's written on the wall. What do I mean when it's written on the wall? Not with very significant due diligence. You can already figure it out. So if somebody has been doing a good job for the last 30 years, in high probability they will continue doing a good job. If someone has done a crap job over the last 30 years and lost other people money and made mistakes, and there's a high probability that in this case you'll also be exposed to those kind of irresponsible management. And so it's really important, the due diligence, to understand, okay, number one, the legal side. So who are we doing business with? What platforms it is? What's the probability that they will actually stand by the promise of the offering? And the second is the economic due diligence. Does it make sense? Can we actually, when we're talking about a return of 6% or 10% or whatever the offering is telling us or offering us, does it make sense? Can they actually do it? When we look at the numbers, do they add up? So due diligence is something we talked about. Compliance, very, very important. We talked about it in the beginning. Our regulators are not happy with us investing all over the world. But I have to tell you something that's the most important. The question that we ask ourselves is not what our regulators want. What do the families that entrust their futures with us need? And then you work around it. I'm not saying that we want to, work in an unregulated world. We want to be regulated. We want to be responsible. And if we are responsible, then our regulators will respect it. There are ways to do everything. But the most important thing is to understand what we need to do. Not what we want to do, what we need to do. And if we understand what we need to do, you will find ways of making those investments for your clients in a sustainable way, in a respectful way, in a professional way. I'm going to end this with a little bit of opportunities of tomorrow, just to understand where the world is going at the moment and where our clients can achieve that extra alpha, the extra margin on their investments of tomorrow with good sustainability. And so one of the things that we are very fond of in the United Kingdom is social housing. Social housing basically is for what we call assisted living. Assisted living is people with disabilities. The government of the United Kingdom provides them with a home and encourages people like us from outside of the United Kingdom to invest, in return receiving a guaranteed contract from the government for a period of 20, maybe plus years, linked to the cost of living. Take into account the cost of living is around about 2%. The CPI in the United Kingdom is between 2 and 3% a year. So basically, if we can buy assets and rent them out to the government, we can create good returns, probably around about 6% without leverage. With leverage, we could actually be close to 8, 9%. And, we can sleep quite well because in the last 400 years, the British government has honored all of its commitments. So, I think we can all sleep quite well based on the fact that we're, working with the British government still. It's very sustainable, very reliable, and if we trust the American economy, you can trust the British economy. I don't think that any of the other economies have a track record of trustworthiness like as the United Kingdom. That's also why British banking is so well respected all over the world. So here, investing in these kind of assets this is a great alternative for government bonds, because instead of receiving the 1, 2, 3% for the 20-year bonds, here we can have an additional 1, 2, 3% on the bond and still live with great trustworthiness, with security, that we understand that tomorrow morning we can wake up in the mornings, not worry about where our money is coming from and how we're going to live the life we want to live. Also take into account social housing, it's ESGs, it's very socially responsible. It's one of the most important things for the British government because, they want to rent 90,000 homes, apartments, in the next 1 year during 2021. Last year they only did 27,000. The year before that they did 47,000. So taking into account that now they're investing a lot of money, they increased the budget by £1 billion this year because of COVID, because more people are actually standing in line to receive, unfortunately, because of the developments. But creating 90,000 apartments is 600,000 jobs in the United Kingdom. So it's an important stage in coming back and investing in the infrastructure so as to create growth within the market. And Brexit, not Brexit, I can tell you Britain is a great place to invest. Greening the grid. So we started with President Obama. One of the most important things that the American government is taking is trying to create a greener environment. And I understand that the new laws are not only encouraging, forcing the market to move into alternative energies. And that's a great place to be. Take into account that, even in that world, which is a massive world, we're talking about trillions of dollars, there is a lot of great opportunities, but there's also a lot of stuff that I wouldn't touch with a 10-foot pole. And also legislation is not completely clear. So the new legislation that came out lately on the investment is a little bit different to what we originally thought. Semiconductors. Amazing. Everything that we do is controlled by a semiconductor. I was sitting outside, a girl was talking about clever clothes. There's a conference over here for fashion, and she was telling me about clever clothes. Okay, I never even knew that it existed. Clothes that can monitor your hearts, monitor the children or the elderly, clothes that can monitor even, she was talking about monitoring whether you're happy, sad, anxious, all kinds of things, so you can see on your phone whether your parents are going through a difficult time, whether they're not feeling good, whether they're worried about something. This is amazing, where the world is going, but it's all fueled by these semiconductors. Our cars, the plane, everything is fueled. So there's, at the moment, the demand for semiconductors has gone up, the supply has gone down. That means that the prices will go up. That means it could be a great investment in the next 3 to 5 years, and something to think about. So I finished, and I don't know if we have any time for questions, maybe 1 minute, but I'd be happy to answer questions now, or if anyone wants to ask me anything outside, I'd be happy to also discuss the opportunities and the challenges of what we do on a daily basis. Okay, so thank you very much, everyone. It was wonderful talking to you, and I hope I have an opportunity to talk to some people later on.